Welcome to Matters Financial and Geopolitical from a Frontier. Thank you for stopping by. Well, let's start with what was the epic event yesterday, which was the Federal Reserve meeting and press conference. And the global stock market and bond markets rallied sharply as Fed's Powell hinted at a punch bowl refill, was how Holger interpreted it. Big rally. Just to give you a feel, the Fed is now projecting a 25 basis point rate cut by the end of 2020, while the market is pricing in 4 rate cuts. And the market has really got its foot on the pedal here. 3rd of June, I was saying I would be tentatively selling 85 basis points of cumulative easing through 2020. And now we've got 100 basis points of easing, and I would not be so tentative about that trade as I was at the beginning of June. However, what we also know is that you don't stand in front of a runaway freight train. The question I asked at the beginning of June is we need to ask ourselves how much further this move may run. I think we're now running on empty. Again, from the 3rd of June, my sense is that G7 bond markets are now in nosebleed territory. Japan's 10-year government bond yields are catching up somewhat with Germany's 10-year Bund yields in the global Japanification race to the bottom. 10-year Japan yields now trade at minus 0.16. Versus German yields at minus 0.32. Gold has hit a 6-year high jumped as high as 1,394.11 an ounce, the highest since September 2013, in point of fact, and was last trading at 1,380.75. It remains the purest geopolitical proxy in the markets, and as Ben Bernanke once said, people hold gold as protection against what we call tail risks, really, really bad outcomes, and in an environment of negative interest rates, holding gold becomes significantly more compelling. The US 2-year yield extended its fall around 1.75%. It was down 11 basis points yesterday and has had only 5 bigger daily falls in the last decade. It is on course for its 7th straight weekly decline, a run not seen since 2011. And this is a chart from J.S. Blokland again. So that really has been the determinant. The sharp reduction in the forward US interest rate curve has softened the dollar and rallied the markets. And the markets took comments from Powell yesterday as a signal to keep on drinking, that the punch bowl was going to be refilled. I'm not convinced that US employment rates, inflation rates will allow such dramatic action by the Federal Reserve, but that will be proved in the future.